Okay, we're going to talk about residential mortgages, Unit 12, quick summary. United States is divided into two different types of states under a different mortgage theory. The first one is title theory. You can see which ones are there. And in this particular case, the title is held by the lender or a trustee until the loan is repaid. This means that they are a non-judicial state, and foreclosure can take between 60 and 90 days when the owner has made all the payments on the mortgage, or when they come up with a lump sum to close it off, they will receive the title. Lien theory states, which Florida is, the borrower actually owns the property and gets the deed, but the lender has a lien on the property and the lender must foreclose through the court, and this is a longer process depending on court schedule, 150 to 200 days. Every mortgage comes with a promissory note. It can be just 1 or 2 pages, promise to repay. It's evidence of the debt, and it gives you the terms of the loan, such as the amount borrowed, interest rate, and monthly payments, and so forth. Also with it is the mortgage document. So I usually say mortgage note and mortgage document as 2 separate items. We can have a look at the mortgage document here. It's 16 or more pages, and it's usually a unified standard document, uniform standard instrument. And this particular one is being used in New York, but they're all basically the same. And in there will be lots of clauses, which we'll go through. Okay, parties to a mortgage. The mortgagor is the borrower and gives the mortgage document as security to repay to the lender. Therefore, the lender, because they're receiving the mortgage document signed by the borrower, is the mortgagee, the lender, and they own the actual mortgage document. When the mortgage has been paid off, the lender is obliged to provide a release of mortgage, which is recorded by the lender to show that the loan has been repaid. The mortgagee, the lender, must cancel the mortgage and send the recorded satisfaction to the mortgagor within 60 days. Mortgage lien priority. The lien is recorded in the courthouse to show that there is a debt owed. Priority is normally determined by the order in which the liens are recorded. The first mortgage is usually the first mortgage loan to be recorded, and then the junior mortgage is a second mortgage or a later mortgage. Subordination agreement is used to voluntarily allow the lien holders to change positions. Maybe one wants to become before the other and change their priority, so they get paid off first in the case of a foreclosure. In the mortgage document, they'll have lots of covenants or promises and agreements. Promise to repay the loan, promise to keep the property taxes paid and to pay off any liens, promise to insure the property, occupy the property as an owner, and promise to maintain and keep the property in good repair, and also promise not to sell off parts of the property that are covered by the mortgage. They will also have a prepayment clause, which is included in FHA and VA mortgages, and a prepayment penalty clause if there is one. Not usually found in FHA and VA mortgages, but they will always have a prepayment clause basically saying that there is no prepayment penalty clause. There's an acceleration clause which will allow them to accelerate the entire amount due in case of non-payment of the monthly payments. There's also the right of the mortgagor, the lender, to reinstate, the borrower to reinstate should they manage to catch up with any defaulted payments. There's also a due on sale clause, which you won't find in an FHA or VA mortgages, but you will in conventional, which means you have to pay off the mortgage if you want to sell it. Then there's the defeasance clause, which basically says that when this mortgage is paid off, then I have to release the lien or issue a satisfaction mortgage note. The mortgage features also include a down payment amount and loan to value ratio that the mortgage is being covered, Equity is the current market value minus your mortgage debt. This gives you your equity in the building or in the property. Definition of interest is the amount that you pay as a percentage per year on borrowed funds. And usually we pay mortgage interest in arrears. We pay interest on the money that we have already borrowed. Loan servicing, they will charge you maybe loan servicing fees, which is as a percentage of the loan amount, usually 1/4 to 0.5%. They may also ask you to keep money in an escrow or impound account, which will be a monthly installment of property taxes and hazard insurance. Here's an example of how we would work that out. How much do we have to keep? Here's an example of equity, 350,000. And the loan is 280, therefore the person has $69,000 equity in the home. Just remember the mortgage features: principal, insurance, interest, insurance and tax. Principal, interest, taxes and insurance, PITI, is what comes out of your monthly payment. For example of an escrow impound account, mortgage payments are $2,186.25 per month. The yearly taxes are $2,850, and the yearly insurance is $1,680. So they're going to take 1/12 of the taxes and 1/12 of the insurance and add it to your monthly payment, which will come to a total of $2,563. And then when the time comes to pay the taxes and the insurance at the end of the year, you'll have the appropriate amount in the escrow account that they can pay on your behalf. Discount points are another way that insurance companies make money. A little bit in advance, they ask you to pay a certain percentage of the loan amount. Each point is 1%. And then that sort of goes into their back pocket, and they can lower the interest rate. And this is said to increase their yield by about 1/8 of 1% yield increase for every 1% discount point they want. So it's an upfront fee to increase the real yield or annual percentage rate. It allows the lender to increase return without actually increasing the contract interest rate. Payment of additional points may allow the borrower to reduce the interest rate. And the payment of discount points is in effect prepaid interest to the lender. Loan origination fees when you're taking out the loan. If you get the loan, then the fee is for generating and processing the loan based on a percentage of the loan called points, and 1 point is equal to 1%. For example, $250,000 loan with 1.5 points will cost you $3,750 loan origination fee. The loan to value is a percentage of the loan compared to the actual value of the home. For instance, if the loan is $180,000 and the home value is $200,000, you just divide the 200,000 into the 180 and you'll get something like 0.9 or 90%. If you do it the wrong way round and you get 1 point something, then you've obviously done it the wrong way round. So another way of looking at it is I've got a $60,000 down payment and a $240,000 loan. Therefore, obviously the home is worth $300,000. Divide that into my loan amount and I get an 80% loan to value ratio. You must know how to work this out. Going back to discount points, cost to the borrower. Each discount point is worth 1% of the loan amount. So if we were taking out a $200,000 loan with 3 discount points, then that would cost us $6,000 upfront payment. We would still have to pay the interest on the $200,000, but the lender only uses actually 194 of its own money. So therefore that's how it gets that extra 1/8 of 1% yield on its loan they have given you. You may be asked to calculate the final calculated interest rate by taking into account discount points. For instance, in this example, the lender charges 2 points on a loan of $120,000 at 4% interest. What would the effective yield be? Well, 2 points is going to be the same as 2/8, and 2/8 is the same as 1/4, which is 0.25. Therefore, we add that to the interest rate, and the effective yield to the lender is 4.25 or 4.25. And just a point here, they won't be asking you any questions in fractions, simply because the computer screen will not show fractions very easily. So you must learn how to convert fractions into decimals. When the bank possesses the mortgage, they may actually want to sell it, in which case they will assign it to a new secondary mortgage holder. Bank possesses many mortgages documents but got no money, so therefore they assign the mortgage to ownership of mortgages transferred from one company or an individual to another. So the bank would be the assignor and the receiving bank would be, or investor would be, the assignee. And they will request, the assignee will request an estoppel letter or certificate to verify the amount of the mortgages and the interest and the dates to which the interest has been paid prior to the assignment, so they know in advance, so they can get their figures together. If you are purchasing a property encumbered by an existing mortgage loan, then there's various ways of doing it. Normally, when we buy a property, we will give the owner either cash or cash from a lender to pay off that essentially purchasing the property for cash. But we may actually, in certain circumstances, be allowed to buy a property and inherit the mortgage with it. So the buyer is not personally liable for the debt. The buyer has title to the property, but the buyer may have a low credit score, for instance, and is just taking over the other mortgage, or maybe interest rates are higher than they can take over the mortgage for. So that's subject to the mortgage. Also, I may assume an existing mortgage, which is very similar to subject to the mortgage, but in this particular case, we're taking over an existing mortgage. The seller is still liable for the original promissory note, but a novation agreement, if included in the assignment, will actually, or assumption, will actually make the buyer solely responsible in the event of a default. A due on sale clause prevents sale subject to the mortgage. Prevents sale of the property that is subject to the mortgage or an assumption of the mortgage. In other words, we do not want you to sell the property unless you pay off the mortgage completely. And we would ask the mortgage company exactly how much is owed so we can clear that debt at a specific time. We would ask them for an estoppel certificate or estoppel letter. Another way of buying property is contract for deed. This is basically seller financing, land contract, usually for raw land. Sometimes it's called a land contract. Type of seller financing is usually a small down payment from the buyer, then the buyer makes regular payments to the seller, and the seller retains legal title until the loan is repaid. When the contract is signed, the buyer does get possession and equitable title. When all the payments are made by the buyer, then the buyers get the legal deed. But only attorneys can prepare contracts for deed. Remember that. We need to know the difference between legal and equitable title. Legal title is when I actually own the property outright, either a fee simple estate or life estate. Equitable title is what a person is expecting to receive in the future. It's the interest that implies that a person will receive legal title at a future date. The interest that the buyer receives, for instance, upon executing a contract to buy prior to title closing. Therefore, I do have some equitable interest in the property, and the seller, for instance, can't decide to go and sell it to somebody else without consulting the original buyer first. We also talk about land development loans and construction loans. A land development loan would be used to fund streets and infrastructure in a new subdivision. Construction loans, they will be used for actually constructing the properties, and they consist of minimal amounts used at a time called draws. In other words, if I'm borrowing $1 million from a construction loan bank, they wouldn't give me the $1 million all at once. They would lend me maybe a quarter of it first of all and do some of the work, They'll come out and inspect it to make sure the value is there, and then they would give me the next draw for the next phase. And all of these are usually short-term financing, 2 or 3 or 4 or 5 year loans. Then we have a blanket mortgage loan, which basically covers a whole lump of land which we're dividing into lots. Normally, under a mortgage, you wouldn't be allowed to sell off parts of what is covered by the mortgage. But with the development of a subdivision, we want to be able to pull the lots out from underneath that mortgage blanket and sell them off one by one and pay off a partial bit of the mortgage. So we have to make sure that in a blanket mortgage loan there is a partial release clause which allows us to sell off the lots one by one from underneath that mortgage. Before a construction loan, a bank will lend a builder money for a subdivision construction or similar, they'll want to know that the builder has actually got lined up a commitment from a permanent lender to provide the funds for a longer term. So they would want to see that from a permanent lender before they lend construction money. And there are opportunities for the builders to buy down the loans on behalf of the customer wanting to buy the land or the construction. And these are similar to discount points, but they only last for 2 or 3 years. We have a quick example on the next page here, where, for instance, a $100,000 loan would normally be 4% for 30 years and would make a monthly payment of $477 from the buyer. In this particular case, the bank allows the builder to contribute to the monthly payments, reducing the interest rate and reducing the amount of payments made by the buyer. For instance, in the first year, maybe the bank will only charge 2%, which will be $369 they want from the buyer. And maybe the second year will be at 3%, which will be $421. Then in the third year, it goes up to the normal 4%. But you can see the bank has got a shortfall between the 369 and the 477 for 12 months, and a shortfall between 421 and 477. We work out what that shortfall is. For the first month, we can see they're short 1,293, and on the second year, rather, you can see they're short 669. So what the construction guy will do, will put into escrow about $1,900, which the bank will draw off of on a regular basis. So the builder puts $1,963 into a special account that the lender can draw from each month to make up the shortfall. And this saves the lender from having to reduce the price of the home to the buyer. Foreclosure. If the borrower does default, then the lender will issue a suit on the promissory note if they want to do it this way. Not very common, because all you can do is sue on the note and obtain a general judgment from the judge for the outstanding note payments, and then execute a judgment against any or all of the real or personal property, but not the homesteaded home. What they normally do is initiate a foreclosure proceeding. And if they foreclose on a property, they call in the acceleration clause. This now makes all of the outstanding funds due, and that way they can actually sell the property. If you are buying a property at a foreclosure sale, just beware, buyer beware. The mortgagor can prevent the mortgagor, that is the buyer or the owner, can prevent the foreclosure by paying the principal and interest due plus collection expenses before the property gets sold, but the right ends once the property has been sold at the foreclosure sale. Sometimes the banks will accept a less amount than is owed on the property because it helps save all the foreclosure costs and the charges and attorney's fees and so forth. So the net proceeds at closing will not necessarily satisfy the payoff amount of the mortgages and other liens on the property, and the seller is selling the home for an amount less than the amount owed, but the sale is subject to all lien holders' approval. Not only the banks, but anybody else has got a lien on the property. And then they will accept a percentage of the money owed to them. To save all that, the owner of the foreclosing property may decide just to hand over a deed. It's a deed in lieu of foreclosure, and the mortgagor transfers title of the property to the mortgagee, the bank. This is called a friendly foreclosure, or sometimes a non-judicial foreclosure, and it saves the bank a lot of time and money, and it sometimes is easier on the buyer, the owner, to actually do this. If an income property does go into foreclosure, then there will be a receivership clause in the mortgage document. This allows the court to appoint a receiver to collect the income directly from the tenants and then pay the mortgage off in the event of the default, or to make the monthly payments in the event of default. And a lease pendings is another word we come across, and that is a notice recorded in public records by the lender through an attorney of pending legal action involving real estate. This is constructive notice letting the world know that the owner of the property is possibly under legal action to go into foreclosure. And that's the end of chapter 12. A little bit brief. Need to read it again to fully understand all the bits and pieces. Thanks very much.